Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Bitmine immersion technologies.
If you find our talks useful, please consider subscribe, like, and comment underneath. And don't forget to check out that VIP Algos link below in the description. So, looking at today's analysis. Usually when we look at corporate financial statements, there is an expectation of, basic mathematical logic.
Right. It should function like basic physics.
Exactly. If a company is selling a ton of its product and growing incredibly fast, the bottom line might be a little messy as they scale up, but it fundamentally makes sense. You look at the balance sheet, you trace the cash, and the numbers tell a cohesive, linear story.
The expectation is always a straightforward progression. A company raises capital, spends money to manufacture a product, sells that product to a consumer, and eventually retains a profit margin. It's just the fundamental heartbeat of traditional commerce.
But then you step into the world of cryptocurrency infrastructure, and suddenly that basic financial physics just completely breaks down. We're looking at a financial landscape today that is totally baffling.
Oh, it really is.
So let's unpack this. We're looking at Bitmine Immersion Technologies, trading under the ticker symbol BMNR. For this talk, we've gathered a really fascinating stack of data to help you make sense of this. We're pulling from Bitmine's raw balance sheets, real-time technical chart data, recent analyst notes from B. Riley Securities, and some broader macroeconomic commentary from market strategists like Tom Lee.
And looking across all that data, there are two numbers sitting side by side on Bitmine's ledger that look like a massive typo.
A complete glitch in the matrix. So first, they have a trailing 12-month revenue growth of 261.26%.
Which is undeniably astronomical. I mean, sustaining anything over 100% is hyper-growth territory, but pushing past 260% suggests a company capturing market share at an absolute historic velocity.
It is explosive top-line growth. But then, and here's the crazy part, you look right next to it, their net margin, the metric that tells you the actual profitability of the company after all expenses, is negative 51,893.54%.
It's staggering.
And that translates to an earnings per share of negative $20.85.
It is the absolute definition of a financial paradox. You have top-line revenues skyrocketing toward the moon, while the bottom line looks like a black hole swallowing capital whole.
It really does. And so our mission for you today is to help you unpack this extreme contradiction. Bitmine currently commands a massive $10.03 billion market cap.
Yeah.
We need to figure out, is this a sinking ship that is just incinerating cash at an unsustainable rate?
Or is it a coiled spring?
Right, exactly. A company executing a massive misunderstood turnaround strategy. To figure that out, to understand how any organization can grow revenue by 260% but operate with a negative 51,000% net margin, we first need to look at what they actually do.
Yeah, we have to examine the physical mechanics of their core technology. Understanding the physical reality of their operations is the only way the numbers will ever make sense.
So what exactly is their edge here?
Well, Bitmine's core economic moat, their unique competitive advantage in a really saturated industry, is right there in their name, immersion cooling. They are a cryptocurrency mining company, but they operate entirely differently from the industry standard.
Because when those people picture a crypto mine, they picture like a massive sweltering warehouse in the middle of nowhere. Just aisles and aisles of thousands of computers with giant industrial fans screaming at maximum volume, just trying to blow hot air out of the building.
Exactly.
Yeah.
Traditional air-cooled facilities operate exactly like that, and their biggest operational enemy is thermal energy.
Heat.
Right, heat. Cryptocurrency mining relies on specialized hardware called ASICs. Unlike your everyday laptop, which is, designed to do a million different tasks moderately well, an ASIC is engineered to do nothing but run one highly complex mathematical equation at blinding speeds.
And because they're crunching these numbers so intensely, they generate a tremendous amount of heat.
Exactly. And heat degrades hardware. It causes silicon chips to fail, and it places a hard physical limit on how fast you can run the machines before they just melt. Bitmine approaches this problem from a completely different angle.
Okay, how so?
Instead of blowing air over the machines, they use specialized immersion cooling technology. They literally physically submerge their ASIC mining rigs into a specially engineered dielectric fluid.
Okay, I have to jump in here because this reminds me so much of building a high-end gaming PC.
Oh, that's a perfect comparison.
Like, if you build a standard gaming rig, you use regular air cooling. You have fans pulling ambient air through a metal heatsink. Over time, it gets dusty, it gets incredibly loud, and if you try to run a graphically intense game, the computer will literally slow itself down.
Right, thermal throttling.
Exactly. Thermal throttling, just so the components don't cook themselves to death.
Right.
But if you build a high-tech, liquid-cooled rig where a specialized fluid is actively pulling the heat directly away from the processor, you can overclock it.
Yeah.
You can push the hardware way past its factory speed limits. It runs silently, and the components actually last much longer because the temperature remains perfectly stable.
That analogy translates perfectly to what Bitmine is doing on a massive industrial scale. The secret to their dielectric fluid is that it is entirely non-conductive. It contains absolutely no free electrons.
Wait, so electricity literally can't pass through it?
Precisely. Because there are no free electrons for electricity to hitch a ride on, the current cannot travel through the liquid. You can take a live, high-voltage mining rig and plunge it directly into a vat of this fluid, and it will not short-circuit.
That is wild, the picture.
It is. And the fluid pulls the thermal energy away from the silicon infinitely faster than air ever could. Consequently, Bitmine drastically reduces their hardware failure rates. They aren't constantly spending capital to replace burnt-out motherboards.
And just like the overclocked gaming PC, they can push these ASICs to run significantly faster than their factory settings.
Which results in superior hash rate efficiency, meaning they successfully process more cryptocurrency computations per unit of electricity than their air-cooled competitors.
And here's where it gets really interesting for the balance sheet. You can actually see the financial result of that liquid cooling tech in their unit economics. Because of this extreme operational efficiency, Bitmine boasts a gross margin of 64.4%.
That single metric validates their entire engineering philosophy.
Yeah, it's huge.
Because gross margin only measures the direct cost of mining the cryptocurrency versus the revenue generated by selling it. It strips away all the corporate overhead, the administrative salaries, the marketing, and simply asks, does the physical act of running these machines make a profit?
And at over 64%, the answer is a definitive yes. The core engine of the business is highly lucrative.
Plus, they aren't just mining Bitcoin and immediately converting it to cash. They are strategically accumulating Ethereum.
Right. They are hoarding ETH to position themselves as key players in the Web3 and tokenization ecosystems, which, for you listening, is a crucial shift. Web3 and tokenization aren't just buzzwords, you know.
No, they represent the transition toward decentralized finance.
Exactly, where things like real estate or legal contracts are digitized and traded on the blockchain. Ethereum is the base layer for all of that activity, and every transaction requires ETH to function.
So by accumulating it, Bitmine isn't just a miner. They're trying to own a stake in the foundational infrastructure of the next iteration of the internet. They're building a diversified treasury of digital assets, moving away from reliance on a single cryptocurrency's price action.
Okay, but this brings us right back to the massive contradiction we started with. A 64.4% gross margin is incredible.
Yeah.
It means their actual daily operations are printing money. So how do we causally get from a highly profitable daily operation to a net margin of negative 51,893%?
It's a fair question.
Where is all that money vanishing to?
Yeah.
That leads us directly into their balance sheet and what the executive management team is actually doing with that capital.
Right. The transition from a positive gross margin to a deeply negative net margin comes down to the aggressive life cycle of infrastructure scaling. That terrifying negative 51,000% figure is heavily skewed by accounting rules.
How so?
Well, net margin has to include all non-cash expenses. In the crypto mining industry, hardware depreciates rapidly. Because new, faster ASICs are constantly being invented, the accounting value of existing machines drops like a stone, and companies have to write off millions of dollars in depreciation.
So it's a paper loss.
Mostly, yes. Furthermore, Bitmine is taking the actual cash they do make and aggressively reinvesting it into building massive new immersion cooling facilities. Finally, because they are hoarding that Ethereum instead of selling it for fiat currency, they aren't showing traditional realized cash profits on the ledger.
Let me make sure I'm wrapping my head around this. It's less about money being set on fire through bad business practices and more about wealth being trapped.
Exactly.
It's locked up in the physical infrastructure of the cooling vats and secured in digital vaults holding Ethereum.
That captures the dynamic perfectly. They are absorbing massive scaling and depreciation costs on paper today to build the physical and digital footprint for tomorrow. Which brings us to a crucial valuation metric for the listener, the price to book, or P/B ratio.
Right. Bitmine has that $10 billion market cap, but their price to book ratio is sitting at 1.0176.
And if a company has a price to book ratio right at 1, that essentially means if they stopped everything today, sold off every server, every drop of dielectric fluid, and paid off all their corporate debts.
The cash left over is exactly what the stock market says the company is worth.
Exactly. We are paying for exactly what is on the floor. There is virtually zero speculative hype or premium baked into the current stock price.
The market is valuing them strictly on their tangible, hard assets. You are buying the fundamental floor of the business.
But accounting theories and book values are only useful if management makes smart capital allocation decisions.
True.
And there's a massive strategic pivot happening right now. Management is actually tapping the brakes on those Ethereum purchases we just discussed. They are slowing down the accumulation of digital assets to fund a massive $86 million share buyback program.
This specific pivot is the catalyst for the entire investment thesis, isn't it?
It absolutely is. This is the moment a company transitions from blind, aggressive expansion to actively managing and defending its equity. Historically, cryptocurrency miners are notorious for constantly diluting their shareholders.
Oh, constant.
Whenever they need cash to buy more mining rigs, they just issue millions of new shares of stock, which shrinks the ownership percentage of every existing investor.
It's a never-ending treadmill. You might own a slice of a growing pie, but they keep cutting the pie into millions of smaller and smaller pieces.
But Bitmine is stepping off that treadmill. By authorizing an $86 million buyback, management is directly fighting that bottom line dilution. They're using their capital to step into the open market and buy their own stock, retiring those shares.
Radically shifting their priorities.
Yes, they are explicitly prioritizing shareholder value over raw asset accumulation.
So how does an $86 million buyback fundamentally alter the mechanics of the stock price for everyday investors?
It creates a synthetic floor. Imagine you are an investor worried about the stock price dropping. When the market knows there is an $86 million guaranteed buyer, the company itself sitting at the bid ready to scoop up shares if they get too cheap, it establishes a structural baseline of support.
It proves, using actual deployed capital, that the management team genuinely believes their own stock is deeply undervalued relative to their current liquidity and future cash flows.
Precisely.
But accounting maneuvers are just theory until they hit the open market. If management is using $86 million to build a floor under this stock, are real-world investors actually stepping onto it? Let's pivot from the fundamental accounting to the real-time price action. Let's look at the chart structure.
The technical setup developing right now is highly compelling. Based on the market data, the stock is currently trading at $16.63. That represents a daily gain of 5.99% or about 94 cents.
And zooming out, it looks like it is rebounding off a pretty significant floor.
The stock just successfully bounced off a 52-week low of $12.80, a level it established back in late June of 2026. However, to put the broader trajectory into perspective, it is still massively down from its 52-week high of $71.74. Yeah, we are looking at a deeply oversold technical structure that is just now beginning to attempt a structural recovery.
Okay, I have to push back here because I'm looking at the momentum data and there's a fascinating contradiction. The chart shows the stock just successfully breached a critical short-term resistance level at $16.05. It even spiked to a high of $16.87 today.
Right, a higher high.
Exactly. In chart terminology, breaking that 1605 ceiling establishes a higher high. For you listening, a higher high is crucial because it proves buyers are finally willing to step in at a higher valuation than the previous peak. It mathematically breaks the psychological downtrend.
It does.
That all sounds incredibly bullish. But, and here's the catch, the volume, the actual number of shares changing hands, is currently running at only 0.81 times the 3-month average. It's below average.
It is.
If this is a legitimate structural breakout, shouldn't the volume be massive? Doesn't low volume imply that the broader market doesn't actually believe in this rally?
It is easy to view low volume on a breakout as a bearish divergence, but it actually reveals a different mechanical truth about market psychology. Lower volume is incredibly common in the very early foundational stages of a breakout.
Walk me through the mechanics of that. Why wouldn't a real breakout have huge volume?
Because the massive retail crowd and the algorithmic momentum traders simply haven't noticed yet. When a breakout initiates on low volume, it frequently indicates that the selling pressure has simply evaporated. The market has run out of motivated sellers.
Uh, so there's no one pushing it down.
Everyone who wanted to panic sell already did when the stock hit 1280. Because there is no one aggressively pushing the price down, it doesn't take a massive, overwhelming flood of new buyers to move the price up.
Interesting.
The volume expansion typically arrives later to confirm the move, once the broader market spots the higher high and rushes in to chase the momentum.
So we aren't looking at some speculative short squeeze orchestrated on a message board.
The data explicitly confirms there are no formal short squeeze flags currently active. The upward momentum, a solid 2.08% return over the last 5 trading days, is being driven by fundamental demand.
That buyback.
Exactly. It is the real-world manifestation of that $86 million buyback quietly absorbing supply, rather than speculative retail froth. It is a slow structural recovery.
The chart definitely shows a company attempting a very quiet, disciplined recovery. But a stock doesn't trade in a vacuum. It trades in the messy real world. To see if this structural breakout actually has the momentum to run back toward those previous highs, we need to zoom out and look at what Wall Street and the broader global macro forces are doing.
Wall Street institutions are certainly monitoring the transition. The analyst notes from B. Riley Securities are particularly revealing. They recently maintained their formal buy rating on Bitmine.
Okay, that's positive.
Now, they did revise their official price target downward, moving it from $33 to $25, which reflects some caution regarding the broader sector.
But let's contextualize that math for a second. The stock is currently sitting at $16.63. Even with a downward revision, a $25 price target implies an over 50% upside from current levels.
It really does.
That is a massive institutional premium over where the stock trades today.
It underscores the disconnect between the fundamental value of the immersion technology and the current battered stock price. The institutional expectation remains deeply bullish.
And backing up that Wall Street optimism, we have some intense macro tailwinds. There's some really fascinating market commentary from Tom Lee regarding the broader crypto ecosystem.
Tom Lee's perspective is vital here because macro crypto trends directly dictate the fiat value of Bitmine's accumulated treasury. He recently noted that in the current market environment, retail investors are, and I quote, rage quitting at the bottom.
Rage quitting. It is the perfect phrase. It perfectly captures that specific emotional capitulation where an investor is held through months of losses, finally throws their hands up in absolute disgust, and sells everything right before the market inevitably turns around.
It is the ultimate contrarian buy signal for institutional players. When retail investors rage quit, smart money quietly accumulates.
Absolutely.
But Lee's commentary goes deeper. He explicitly compared the future trajectory of Ethereum to companies like Amazon or NVIDIA. He views Ethereum not just as a digital currency, but as the foundational infrastructure, the base compute layer for the future of the internet.
If Ethereum is the NVIDIA of Web3, serving as the required gas to execute smart contracts and tokenized assets, then Bitmine's strategy of hoarding ETH is a massive macro tailwind. If Ethereum scales even a fraction of the way NVIDIA did, the fiat value of Bitmine's digital balance sheet absolutely explodes.
Their treasury transforms from a speculative holding into a deeply valuable foundational asset.
Okay, I see the vision. I really do. But I have to play the skeptic for a minute and bring us back to harsh reality.
Go for it.
While Tom Lee is forecasting Ethereum as the next NVIDIA, there is a very heavy, very real geopolitical drag pulling the market down right now. Ongoing U.S.-Iran tensions are keeping major cryptocurrencies, including Bitcoin and Ethereum, completely flat.
That's true.
Severe risk-off headwinds are blowing through the global markets. When geopolitical tensions spike and the threat of conflict looms, institutional investors do not typically run toward highly volatile digital assets. They run toward traditional safe havens like cash, treasury bonds, or gold.
The geopolitical reality definitely must be weighed impartially. The crypto market is managing to hold its crucial technical support levels. We aren't seeing a catastrophic crash, but the momentum is undeniably stalled by these macroeconomic fears. Capital is waiting on the sidelines for geopolitical clarity.
And that tension between the bullish 50% upside targets from B. Riley and these incredibly bearish geopolitical realities leads us perfectly into a hard look at the bear case. What happens to Bitmine if these macro headwinds actually win out? Let's refocus on that terrifying net margin of negative 51,000%.
We have to acknowledge the absolute worst-case scenario.
Right. If this U.S.-Iran geopolitical drag continues for months, suppressing cryptocurrency prices, the fiat value of Bitmine's accumulated treasury plummets. Furthermore, the daily value of the new coins they are mining drops.
Yes, that's the risk.
What happens if their top-line revenue stalls out entirely before they manage to reach actual cash flow break-even? They are burning mass amounts of capital to build these immersion facilities. If the macro music stops, doesn't this entire $10 billion operation just slam into a brick wall?
If the macroeconomic environment forces a prolonged crypto winter precisely when they are most aggressively scaling, the cash burn becomes toxic.
What?
They're going to be forced to abandon the buyback just to keep the lights on.
Exactly.
However, we have to balance that existential risk by pointing back to the two fundamental safety nets we analyzed earlier.
The buyback floor and the gross margins.
Consider the structural defenses they have built. First, the $86 million buyback program. If the stock starts to slide heavily because of macroeconomic fear regarding Iran, management is sitting at the bid, ready to absorb that excess sell pressure.
That artificially protects the downside for current equity holders.
Exactly. Second, and more importantly, that 64.4% gross margin. This metric proves that their core operation, the physical immersion cooling and the mining of blocks, is highly profitable on a strict unit economics basis. They are not running a fundamentally flawed business where it costs them $2 in electricity to mine $1 of Bitcoin.
Right. The massive net losses are a symptom of rapid forward-looking infrastructure scaling, not a broken core product.
Therefore, if push came to shove and the macro environment collapsed, Bitmine could theoretically halt all new construction, pause the aggressive expansion, lean on those 64% margins, and simply run their existing immersion rigs to generate free cash flow and weather the storm.
The foundation of the business is rock solid, even if they are currently spending every cent they have trying to build a massive skyscraper on top of it.
That is the exact dynamic at play.
So, what does this all mean for you, the listener? We've analyzed the physics of their immersion cooling tech, the mathematical paradox of their margins, the strategic pivot of an $86 million buyback, the quiet exhaustion of sellers on the chart, and the looming geopolitical storm clouds. Synthesize all of this into a final verdict for us. What is the ultimate read on BMNR from the data?
Based on the synthesis of all our data, the final verdict outlines a highly asymmetric risk-to-reward profile. The setup earns a 7 out of 10 bullish score.
A 7 out of 10. Okay, quite strong.
Bitmine is a hyper-growth crypto infrastructure company trading a massive 76% of its 52-week highs. It is presenting a rare, structurally supported turnaround setup. You have the fundamental financial fuel of an $86 million share buyback paired with a confirmed technical breakout above the 1605 resistance level.
And what is the projected timeline for a setup like this?
The analysis outlines a target horizon of a 1 to 3 month swing trade. The strategic goal is to hold through the active execution phase of the buyback program, anticipating that the broader crypto market will eventually experience a macro relief rally if global geopolitical tensions stabilize.
That makes sense.
With Wall Street targeting a $25 valuation and those industry-leading 64% gross margins protecting the operational downside, it presents a compelling near-term opportunity.
It really is a fascinating picture of a complex company in the middle of a massive transition. Thank you all for joining us on this talk on Bitmine Immersion Technologies. But before we sign off, I want to leave you with a final, slightly philosophical thought that looking through this data sparked for me.
Oh, what's that?
Well, we are watching Bitmine intentionally slow down its actual operational growth, buying fewer assets, in order to funnel $86 million into buying back its own stock. They are essentially acting as a market maker for their own equity during a crypto bottom. So the question is, if cryptocurrency miners begin scaling back their physical hardware operations just to manipulate their stock float and hoard digital treasury assets like Ethereum, at what point do they stop being technology infrastructure companies and simply become synthetic, publicly traded crypto hedge funds?
The line separating a hardware technology company from a pure financial vehicle is getting thinner every single day.
Something to mull over as you watch the charts this week. Remember, if you find our talks useful, please consider subscribe, like, and comment underneath. And be sure to check out the VIP Algos link. That link is below in the description. Keep questioning the data, keep analyzing the mechanics behind the market, and we will catch you on the next talk.